Let's talk about the management of bull put spreads at expiration to avoid or at least reduce losses and to keep bringing income into your account. I want to help you start with the end in mind and plan ahead for trade management just in case. This mindset leads you to set up better trades at the outset. I'm Patricia Saylor, Managing Partner of Saylor Financial Fundamentals, and this is the fifth episode of a five-part series on trading and managing bull put spreads. As you watch this video, if anything is confusing, check out the entire playlist. This information will make a lot more sense if you understand the content in the earlier episodes first. Episode 1 even has a 10-question quiz to help you decide if you're ready for this strategy, and if you're not, I suggest some ways to build your background knowledge. Unlike buy and hold investing or even selling cash secured puts, if you are trading bull put spreads, you will need to keep a pretty close eye on them. You'll need to plan to intervene if they don't go your way, or if they even look like they may not go your way. You will also need to know your broker's policies about handling these contracts at expiration, so you can take necessary action and know what will happen if you don't take action. And if you are new to options trading, take my advice here and do not trade these bull put spreads yet. Start with more forgiving, easier to manage trades, such as cash secured puts and covered calls. Don't worry if you need to back up a bit. You can find lots of content available on my website, Udemy courses, and in my ebook. There's even a Where Should I Start page on my website. I want you to be successful, so please don't jump in over your head. Bull put spreads will still be here for you when you're ready. In this episode, we'll be looking at the outcome and management of a bull put spread. We will review the possible outcomes of your contracts, discuss ways to handle or avoid assignment, including accepting a loss, taking profits early, rolling for a net credit, and keeping some cash in reserve for trade management and repairs. We'll take a deep dive into the rolling process and discuss the importance of knowing your broker's policies for handling these trades at expiration. It's kind of a lot, but for me, it's important to understand and have a plan before I need it. I really don't like to lose money, so I think this is the most important piece of this 5-episode series. Remember to stay through the end to make sure you understand everything. There's a terminology review, a set of comprehension questions, and a practical homework exercise. They will help you understand what it's going to take to minimize your risk and manage these trades if things turn sour. In episode 4, we took a really deep dive into the possible outcomes of a bull put spread. In it, you learned that there are 4 possible ways this trade can end up. In outcome number 1, both options expire worthless. This is the best case scenario. Option number 2, the stock drops below the long put. This is the worst case scenario. Outcome 3A, the stock ends between the strike prices and specifically above the long strike and below the break even. In outcome 3B, the stock again is between the strike prices, but in that narrow range above the break even, but below the upper strike. As your trade approaches expiration, you have some decisions to make. If the higher leg of your trade goes in the money, or even if you are close to going in the money, you risk incurring a loss. Let's look at your choices to manage the trade if that happens. You might accept a loss and free up capital for another trade. You can take profits early or roll for a net credit. On December 16th, I sold a 4 days to expiration bull put spread on SPY. The share price was $606 and I chose strike prices of $595 and $593. I generated $10.01 in premium for an annualized rate of return of 6.09% on the $200 I was using to secure the trade. On December 19th, the day before expiration, the share price was $588 and both strikes were in the money. I needed to decide how to manage the trade. Accepting a loss is my least favorite approach to trade management. I really hate to lose money, but I also don't want to double down on a bad trade. So if my sentiments about the underlying stock or ETF have really changed, I might consider accepting the loss and moving on to a different opportunity. This video, recorded in real time the day before the SPY trade expired, shows that if I decided to close the position a day early, it would have cost me between $175 and $180. So today I have a problem. I am short a bull put spread on SPY that expires tomorrow. The current share price is $588.78. I sold it on Monday, December 16th, when the share price was $606.72, and my strike prices are $595 and $593. So this is a $200 spread that is in the money and it's expiring tomorrow. If I wanted to close these out today, like right now, it would cost me $176. If I wait until tomorrow, which is expiration day, it's going to cost me $200 to close these out. And see, even right now, it's already bumped up to 182, 181. Another choice for trade management that was not available to me with the SPY trade is to pay a small amount to close a trade and take profits early. For example, when I opened the SPY trade, I received a net credit of $10.01. If the strikes had remained out of the money on the day of expiration or the day before, I might have been able to close it for a small price. For example, if I paid $4 to close the short put and received $1 to close the long put, the closing trade would cost me $3. Even with $1.32 in transaction fees, I'd still end up with $10.01 minus $4.32 for $5.69 in profits, and I'd free up my capital for a different trade. I also can roll a trade for a net credit. In the next section, we're going to examine this rolling process in more detail and explain why keeping some cash in reserve helps you leave room for adjustments. But these are the basics. Rolling means closing your current spread and opening a new one, often with a later expiration date to give the trade more time to recover. Adjusted strikes to reduce your risk of assignment or align with the stock's new price. A net credit. Ideally, you collect additional premium, offsetting potential losses. You can roll a bull put spread by doing these things. First, close the current position. Reminder, this is true of all options. If you sell to open a position, you must buy or pay to close it. If you buy to open, you sell to close. Next, open a new position. Choose new strike prices and expiration dates that align with your updated outlook. Sell a new short put and buy a new protective long put. Complete all 4 legs of the roll in a single trade. The 2 closing orders, a buy and a sell, and the 2 new opening orders, again a buy and a sell, will all be executed in a single order. I always aim to roll for a credit. When you add up the buying and selling of all 4 legs of the roll, you want to make sure you are paying out less than you are bringing in. Rolling a bull put spread out in time can create 3 benefits. It can generate income, lower the strike prices, which reduces your risk of assignment, and allow more time for the share price of the stock to recover. But there's a trade-off. In order to generate a credit and lower your strike prices, you may need to increase the width of the spread. Increasing the width of the spread increases your potential loss if the new position is in the money at expiration. Let me explain. The spread is the distance between the 2 strike prices. It determines how much capital you are devoting to the position. Widening the spread means you are devoting more capital to the trade, and if the position continues to turn against you, the wider spread puts you at risk of a bigger loss. So you have to balance the increased risk of devoting more capital to the trade against the decreased risk of assignment when you lower your upper strike. You can balance these priorities as you select the expiration date and strike prices of the new spread. Again, there is no one right formula for doing this, but if you understand all the parts of the trade and how they work together, you can make decisions that align with your priorities and risk tolerance and your expectations about the movement of the underlying share price. In my trade on SPY, I have a short put with a strike price of $595 and a long put with a strike price of $593. So my spread, or the capital I have at risk, is $2 a share or $200 total. Since the share price has dropped to $588, both legs of the trade have gone in the money, and I want to roll the position to reduce my assignment risk. In order to close the existing open two-part bull put spread, I must buy back the higher strike, or the short put, and sell the lower strike, or long put. We have already seen that these two closing trades will cost me about $180. So I look for a spread expiring about a week out that will both reduce my risk of assignment and generate more than $180. I want to use the new contracts to both pay for the closing orders and still receive a net credit for the roll. So let's take a look at the actual trade I placed in my own account to manage this position. I considered several dates and strike prices, and I talk aloud about my thinking to show you the process I go through. Once you watch it, I'll share some analysis. So remember, I always keep cash in reserve in case I need to repair or roll out one of these positions and expand it to get a new net credit. So I'm going to try to roll my short put out of the money. So I'm going to look for a new spread that will bring in more than I have to pay to close this one. And I still have $771 available, so if I need to expand this trade, I can do it. So let's look at the option chain. All right, I'm going to look at these two dates, December 27th and December 31st. And I'm going to go out a whole week to December 27th and try to roll it down close to the money or even out of the money if I can. So a $588 or $589 put I could sell for $638. And let's see if I can find one to buy for $400 or just a little more than $400. I could buy one with a strike of $582, but that would bring me $700 spread rather than $200. So I would use up an extra $500 of my available cash, but I would be rolling it close to out of the money and giving it another week to recover. Let's look at December 31st, because I really would like to get this strike price down. Let's look at 585, and if I set it at 585, expiring 12 days out, I could bring in about 600 to 585 to 576. That's a pretty big spread, maybe 577. See if I can roll this for a net credit and lower my strike price. Okay, that's a $300 spread, a $400 spread, still probably not a net credit. A $500 spread, looks like I could get a net credit. Let's see if I can get, I'm going to aim for 14. Unlikely, but if it doesn't fill, I'll try something else. Look at that. It filled. So let's put that on the spreadsheet. It filled at 15, so I got 1301, and I now have a $500 spread. All right, that's a very respectable 118.72% annualized return. And 588.49 is the current share price. So I haven't quite rolled it all the way out of the money, but I've rolled it further, or almost out of the money. And I increased the risk a little bit by putting $500 at risk instead of $200, but I decreased the risk by lowering the strike of the short put. So I think that's a pretty good balance with a decent annualized return, and I am so far okay with this repair. And we'll see what happens over the next week. I'm hoping the share price will recover above 490. Oops, sorry, not 490, 590. Put those numbers in wrong. Let me change my hundreds place digit. Doesn't change the spread. While I make my trade decisions, I look at 2 possible dates and several combinations of strike prices. I ultimately choose an expiration of December 27th and new strike prices of 590 and 585. I add 7 days to the trade and increase my capital at risk from $200 to $500. I generate a net credit of $13.01. Lowering the upper strike of the position reduces my risk of assignment. Lowering it also reduces the income from the trade. Lowering the strike of my long or protective put increases the spread, but is necessary to generate a net credit on the roll. Now I'm almost out of money. I've lowered my risk of assignment, and I got paid again. It's all good, but I have increased my risk from $200 to $500. So I'll be watching this trade carefully and looking for a good place to exit it or roll it again and reduce the spread. When choosing your rolls, there are trade-offs you need to understand. Reducing the strike prices reduces your risk of going in the money or being assigned. Increasing the spread increases your potential loss if the trade goes in the money anyway. The decision about which risks and protections you prioritize in your trade management is ultimately up to you, and that's why I emphasize understanding these trades at the outset rather than blindly following someone else's recommendations. Here's what I want you to remember. Outcomes depend on the stock price at expiration. Stay proactive to avoid surprises. Rolling is a flexible tool. Use it to create time for a position to turn around, lower risk, or even turn a losing position into a profitable one. Protect your capital. Avoiding a loss is just as important as capturing profit. By staying on top of your trades and using strategies like rolling, you can minimize risk and keep your portfolio growing. There are several ways that I manage risk in my portfolio. I choose high-quality underlying positions that are unlikely to go bankrupt or trade down to zero. I choose diversified positions which do not necessarily trade in alignment with each other. I work with stocks or ETFs that are heavily traded, with frequent expiration dates and lots of strike prices available. I keep about 1/3 of my cash available in case I need to repair a trade. I vary my expiration dates to avoid having too many contracts expiring at the same time. In my own portfolio, I've been trading SPY, GLD, which is a gold fund, IWM, and QQQ. If I need to repair something or expand a trade, I reduce trades on other positions to free up cash. I may allow another position to expire out of the money or even close a different trade early to make sure the cash is available before I need it. Available cash is my insurance policy. And last of all, let's talk about what can happen if you don't stay on top of these trades. If you allow your trade to reach expiration and you take no action, there are several things that can happen. If both strikes stay out of the money, meaning the share price is above both strikes at expiration, you'll be fine. Both options expire worthless and just disappear from your account. If both strikes are in the money at expiration, meaning the share price is less than the lower strike price, your broker will probably take care of that for you as well. As we discussed earlier, you'll buy 100 shares paying the higher strike price for them, and you'll immediately sell them for the lower strike price. You probably won't see the shares actually enter and exit your account, but you'll be charged the difference between the cost of buying high and the smaller return of selling low. It's not a great outcome, but if you have planned ahead, you know what your maximum loss can be and you can prepare for it. But if the share price is between the strike prices and you don't do anything, your broker may handle the account in ways that you are not prepared for. If the short put goes in the money, you might be assigned to buy the shares. If you don't have enough funds in your account, there are several things that could happen. We'll use as our example the 595-593 spread on SPY. One possibility is forced liquidation. If you are assigned to buy the stock and lack sufficient funds, your broker may just immediately sell the shares to cover part or most of the cost. For example, the share price is $594. You're assigned to buy 100 shares at $595, but you only have $500 in your account. Your broker might sell the 100 shares on the market at a loss to make up the difference. So, in summary, you buy the shares at $59,500 and your broker sells them at $59,400. You incur a $100 loss. Another possibility is a margin call if you have a margin account. If you are trading in a margin account, your broker may use margin funds to complete the purchase. Margin is borrowed funds. This means you'll owe the broker the balance plus interest until you deposit more funds or sell the stock or sell something else to raise the cash. If the share price is $588 and you only have $500 of free cash available, you're assigned to buy 100 shares at $595, costing $59,500. Your broker loans you $59,000 to pay for the shares. You pay interest on the $59,000 at your broker's current interest rate. This outcome depends on your broker's policy and whether you have margin privileges. You may encounter account restrictions. If your account doesn't meet the financial requirements for the trade, the broker might flag your account, leading to restrictions on future trading. For example, requiring you to trade with only cash-settled funds. You may even have to pay fees or penalties. Brokers may charge additional fees if they have to intervene to resolve insufficient funds. Check your broker's terms for specific policies. I have recently encountered two different scenarios that I want to share with you. The first was one of my one-on-one coaching clients who had opened his first bull put spreads expiring on December 20th. He had a position on SPY with strike prices of $595 and $592. Coincidentally, as described above, I had an almost identical spread also expiring December 20th with strikes of $595 and $593. On December 19th, with the share price at $588 and both of our positions in the money, we both had decisions to make about how to manage the trades. He asked me for a Zoom consultation so I could talk him through his trade management decision. He and I ultimately decided to take different routes to manage our trades. I rolled my put out to a new spread expiring 8 days later on December 27th with strike prices of $590 and $585. These were my thoughts. I reduced the short put by $5 a share from $595 to $590. The short put was still in the money by a couple of dollars, but I had 8 more days to wait and watch for the share price to recover. If the share price did not recover, it would be easier to roll out again because I had reduced the upper strike by $5. I increased my capital at risk from $200 to $500. I was glad I had reserved a third of my cash in the account for trade repairs. I had some other positions in the account that were likely to expire out of the money in the upcoming week. I planned to let that happen and wait to set up new trades. This plan would free up more cash in case I needed to expand the SPY position again. My client, on the other hand, decided to close his position and accept the loss. This was a good decision for him, and this was his reasoning. He had another position on another underlying stock expiring the same day that had performed better. The gain on the other position would almost completely offset the loss from SPY. These two trades were his first two bull put spreads, and he was not 100% certain he understood all of the risks and the way the trades could play out. So he wanted to take a step back and reset and learn more about trade management. He was hesitant to expand the SPY trade and put more capital at risk. Closing the day before the position expired meant his loss was less than the full $300. He was glad this happened early in his learning process and that the lesson had only cost him a few dollars. The other scenario came from a Reddit poster who, in December of 2024, sold a bull put spread on Alibaba, expiring in April of 2025. He was expecting the share price to rise significantly, so he set up a trade with both strikes in the money. His upper strike was $130 and his lower strike was $100, putting $3,000 at risk when he only had $2,000 cash available in the account. He received $220 when he set up the trade. With the share price at about $88, the $130 put was assigned to him very early, costing $13,000 that he did not have. The setup was very risky because he put his capital at risk of assignment right away, and he didn't have the capital available to repair the trade. As of the time of this recording, his account is in arrears. He owes $13,000 for the 100 shares he can't afford, and he has a put with a $100 strike price that he can't afford to exercise. I asked what he decided to do, and he said his broker had locked up his entire account, including the shares, so he will have to wait until April to resolve the position. I'm sure he's paying interest on the $13,000, and he may have lost his option trading privileges. I hope the share price goes the way he expects, or that he finds the funds to add to his account to resolve the mess. If you are at risk of assignment and you don't have sufficient funds in your account to pay for shares, there are things you can do to avoid messy outcomes. You can close the option early. If it looks like the stock price will drop below the strike price of your short put, making assignment likely, you can buy back the short put option before expiration. This avoids assignment altogether, though you may incur a loss. If you pay to close the short put, you can sell the long put at the same time and probably offset some of the closing costs. Monitor your positions. Keep an eye on options approaching expiration to anticipate potential assignments. Ensure your account has enough funds to handle any assignments. Use a margin account with caution. A margin account can provide flexibility, but it's important to understand the risks and costs, as borrowing to cover the trade can lead to significant losses. But sometimes using margin as a short-term bridge helps you stay out of trouble. And as we have discussed, you can roll the option. If the option is in the money near expiration and you want to avoid assignment, you can roll it to a later date, possibly with a lower strike price. You may need to expand the spread in order to generate a net credit. If you don't have enough funds, assignment can lead to forced sales, margin debt, or account restrictions. To avoid this, actively manage your option positions and maintain adequate cash reserves for potential obligations. This is a really packed episode with a lot of information. So if you are seriously considering this strategy, I do hope you take the last few minutes to review the terminology, answer the comprehension questions, and do the homework assignment. Watch to the end, then you can go to my website for a downloadable guide with definitions and answers and detailed instructions for the homework. I hope you'll drop a comment to let me know what you think and ask any questions you still have. Your feedback not only motivates me to keep making content for you, but it helps me make it better. Review these terms to make sure you understand them well enough to use them in conversation to discuss your trades. Bull put spread, assignment, expiration, broker policies, net credit, rolling, strike prices, spread, long put, short put, in the money, out of the money, break even, forced liquidation, margin call, account restrictions, margin account, net debit, option premium, capital at risk. Can you answer these questions? What are the 4 possible outcomes of a bull put spread at expiration? Why is it essential to know your broker's policies when trading bull put spreads? Explain the term rolling in the context of managing a bull put spread. What are the benefits of rolling a bull put spread to a later date? Why might a trader choose to accept a loss instead of rolling a position? What happens if a trader is assigned and doesn't have enough funds in their account? Define in the money and explain its significance for a bull put spread. How does increasing the width of the spread affect risk and capital requirements? What are some strategies to avoid messy outcomes at expiration? What is a margin call and how can it impact your account when trading options? For your homework, we're going to practice rolling a bull put spread. Start by setting up a paper trade in your account. Choose a stock or ETF and create a bull put spread with 2 options expiring in the next few days or weeks. Record the net credit you receive and your maximum possible loss. Then, monitor your trade as the stock price fluctuates. Log daily changes and consider rolling if the stock approaches your short put strike price or expiration date is near. When rolling, evaluate your choices carefully. Look for later expiration dates and adjusted strike prices to achieve a net credit and reduce your risk. Finally, reflect on what you've learned. What trade-offs did you consider, and how did rolling affect your position? To help you with this assignment, I've created a detailed step-by-step guide you can download from my website. I'll walk you through each part of the process, so be sure to grab that before you start. And don't forget, share your reflection in the video comments. Thanks for watching. If this video helped you clarify how to manage bull put spreads and avoid losses, give it a thumbs up and subscribe for more practical options trading tips. And don't forget to check out my website for lots of free content as well as resources available for a small cost. Check out my next playlist where I'll be sharing the trades and management strategies that I'm using in my own account. See you in the next episode.